Welcome to our latest webinar for corporates. In this series, we'll be examining recent events and looking ahead at what might be in store for financial markets and the economy. Welcome to the February edition of the FX webinar. We got a great attendance to the January one, and hopefully this February webinar will be no different in terms of the insight that we're able to provide. So today you get me first, whereas last month you had Piers first. I'm going to go through my views and thoughts with regard to the macroeconomic position, and then we'll hand over to Piers and he'll give you the technical outlook. So without further ado, let's go straight into the content, and you'll see that my slides are organized pretty similar to how they're always organized. So we'll look at growth and then inflation and interest rates. I wanted to just focus on labor markets because we've seen some stuff from the central banks recently about average earnings growth and how important that might be in terms of determining when and by how much interest rates will be cut. Then we're going to have a look at politics. Obviously, there's been some interesting stuff with regard to the Republican nomination race. Follow that up with some FX market forecasts, and then finally switch over to the disclaimer before I hand over to Piers. So moving on to the next slide and looking at 2024, we've had these figures from the IMF, so their updated forecast. And the things I wanted to draw out here is weaker economic activity generally amongst the major economies, with the exception of Euroland and the UK. But if you look at other economies, they're liable to perform much worse. The weakness that we're seeing as regards the economies here, predominantly driven just by the ongoing hikes that we've seen to interest rates globally. So there's pressure from monetary policy. There's also a much less receptive fiscal policy outlook as well. And so if we look at the US growth expected to be slower in 2024, albeit that the numbers into the end of 2023 continued to surprise to the upside, which may delay any interest rate cuts that we get from the Federal Reserve. And as I say, the UK and Euroland not performing particularly well, underperforming where the economy of the US is likely to trade and grow over the course of 2024, but some closing in those growth differentials by 2025. So a much more positive picture into 2025. Predominantly, I think that is driven by the expectation of lower interest rates. So lower interest rates across all of those three major economies. Global growth not really picking up that much. And I draw attention to China and the poor performance of the Chinese economy. So we move on to the next slide and we look at what's happening as far as inflation. Well, the first thing I would say is that inflation is no longer the threat that it was for central banks. So interest rate hikes are now off the table for all of those major central banks. We're not going to see another hike unless there is a resurgence of inflation. Now, people have drawn the assessment that the recent problems in the Red Sea, which has led to a sizable increase in the cost of freight, could be an inflationary input. But the domestic inflationary inputs are much slower, much lower rates of price inflation, in some cases price deflation. And I think that will take precedence over the increase in freight costs, which I'd expect that will normalize over the course of the next few weeks and months. And the other thing to note as well is we're still getting, I think, a material worsening in the economic performance of a number of key economies in Euroland, which could lead to disinflation or deflation in those economies. And certainly if you look at the likes of the Netherlands or Italy, they've got very little inflation by the EU harmonized measure. We're seeing stronger levels of inflation in other countries, but quite a lot of that, for example, Germany, that's down to the adjustment that we saw when the German government removed the energy price discount. So they effectively were cutting energy prices for householders. So that led to that jump in the headline inflation rate but that has been short-lived. So I don't think we should be concerned about inflation. And if we're looking at core inflation is still on a relatively steady downward track. So good news there in terms of central banks not having to do more on the monetary tightening front. And eventually we will get much closer to target levels such that central banks will feel emboldened to cut interest rates. So if we look at interest rates in this next slide, interest rate cuts are coming. We're pretty aggressive on the rate cuts that we're expecting out of the US. I would suspect that the numbers out of the US at the moment would dissuade them from doing big cuts in the second quarter. I think that the risks for interest rates in the US is that they come later but are perhaps more significant. So the second half of the year, we could see much deeper rate cuts out of the US. But I think the same thing can be said about the UK and Euroland. So let's just wait and see whether or not we get a big cut from the US in the second quarter, or whether they wait until the second half of the year. They will likely lead the way in terms of the Federal Reserve goes first, the European Central Bank then follows suit, and eventually the UK Bank of England will start cutting interest rates, but only in the second half of the year. And I think one of the other things to note is that we are going to get a whole host of revised data out of the UK from its labour market, and that may well be critical in terms of the timing of any first rate cut from the Bank of England. Speaking of labour markets, if we look at the next slide, average earnings growth, as I mentioned in the intro, has made a resurgence in terms of as a key priority for central banks. Excuse me. And so, although you might be watching unemployment rates, you might be watching non-farm payrolls, as far as the US is concerned, it's average earnings that I think will be the key trigger for any monetary policy loosening that we see out of the major central banks. And at the moment, average earnings growth is still too high. So that probably means that we've got at least another quarter, possibly in the UK's case, another 2 quarters before we start seeing interest rate cuts. For the Eurozone, average earnings growth is slipping more quickly, or has slipped more quickly than we've seen in other economies. And we've got Germany here on this particular graph. But if we look at the Eurozone as a whole, then average earnings growth is weakening, predominantly because the labour market has loosened enormously. And if we look at this in terms of sectors, we've definitely seen a massive underperformance as far as the Euroland construction sector is concerned, or if we were looking at logistics and transportation or auto production, both of those are underperforming versus the rest of the economy. But even things like retail sales, even things like services, they are seeing pressure as well in terms of business, and that will reduce labour demand and therefore the rates of pay growth that we're seeing. So disposable incomes are under pressure, and that could mean that we're not going to get a sizable recovery in economic growth until maybe the last quarter of 2024 or perhaps into 2025. Moving on to the next slide. Well, is the Republican race over? Virtually everybody has dropped out, and that could mean that Trump is running unopposed into the nomination. The only thing that potentially could scupper his plans is if this court case is accelerated such that it comes to trial and a conclusion of that trial before the November election. But at the moment, he is a massive front runner in this particular race, regardless of the amount of money that has been spent by other candidates. So I can't see there being another possible candidate for the Republican race at the moment. The only thing that could derail Trump's attempts to get to regain the presidency is this legal action. So it looks to me very much as if the race is over, but we will see. You know, there may be more formal announcements coming. If we move on to the next slide, we haven't really seen much of a change as far as our forecasts for FX markets. So whether we're talking about sterling dollar or euro dollar, we still think that there is some upside potential for both of these currencies heading into the second half of 2024. And that is centered around the forecast for big interest rate cuts from the US, outsized interest rate cuts from the US versus what the UK and Eurozone are likely to do. And it's certainly, if you look at the interest rate probability, so what is expected by markets, our view on the US is materially different to market expectations, whereas our view for the UK and the Eurozone is pretty much in the pack. It's part of the consensus. So I think that we could see quite a material move in the US dollar, a favorable move in the US dollar, if there's any sense that the Federal Reserve are going to have to go more cautiously with regard to their interest rate reductions. As a consequence, the risks on the dollar would be asymmetrically skewed, and sterling dollar asymmetrically skewed to the downside, euro dollar the same in terms of those forecasts that you see. Of course, there are other things, geopolitical events, for example, that could lead to some detrimental US dollar effect. But overall, I think we're going to see the US dollar potentially strengthening if those rate cuts are pushed out and they are much less significant than is currently priced for, either by ourselves or indeed by the financial markets. Finally, just wanted to refocus for a second on dollar China. Big problems in China revealed recently with the winding up order for Evergrande. I think that sort of economic issue is going to be one significant problem after another for China that could keep the Chinese renminbi weaker for longer versus the forecast that you see on the screen. So again, an asymmetric risk here. The dollar China is higher, the dollar is stronger against the Chinese renminbi because of the macroeconomic problems that China faces. So that's really it from me. It leaves me only to leave you with my disclaimer, which is this next slide. Piers, I'll leave it to you to give the technical outlook. Thanks very much.
Thanks, Neil. So I'm going to look at the yearly charts today and look where the longer term support and resistance levels to watch are. And I think the good thing with charts, we've just had a lot there. And over the last few years, we've heard a lot about politics, central banks, interest rates, inflation, unemployment, economic forecasts, incorrect economic forecasts, market goes here, market goes there. And of course, no forecasting is going to be 100% accurate. However, I believe there's a simpler way to look at the market, and rather than have one forecast rate, looking at potential range for the market over a period, and when that range breaks, you look for the next new range. And I think that's what we're going to see on the charts. We can just completely wipe out worrying about all those interest rates, inflation. It all just moves with the lines. But the one thing I would say, and I always like this as a start of year sort of thing to sort of think about, always be prepared for the things that are not on your radar, as that's what causes the unexpected large market moves. You know, we've heard a lot about all these events that might happen, but it's the shock, I think, some shock, which always moves markets. So always be prepared for that as well. But let's get on with the show anyway. So on that's just saying what I've just said, so it'll be sent out later with the pack. And on the next slide, we're going to look at the dollar index. So I'm going to start with the dollar index because it is crucial to the FX markets. And as I said, I'm not going to talk about central banks, inflation, politics, wars, economic forecasts, just simple lines. It's not that complicated, trust me, because if I can do these, anyone can do these. Now, I've put a yearly chart on here, and this is the dollar index with Fibonacci retracements. We always look at the Fibonacci retracements, and we always talk about the 38.2% retracement. That's where if a trend's intact, that's where it's got to hold that level to be the impulsive trends. We had that huge move down, going down to the lows in sort of 2008. And since 2008, it's been an uptrend. There's a trend line going up through the bottom. We've seen price move back above that pink line, which is a 20-period moving average from the Bollinger Bands. And what have we done? We've simply moved to the top of the Bollinger Band. But what's also where the top of the Bollinger Band is, it's the 38.2%. So while that area caps the market, the dollar's just stalling for the moment. And that's in the sort of 106, 108 area. So on a long-term view, if you're thinking, is the dollar going to strengthen long-term, you need to see the dollar index above 106, 108. If it gets above there and starts to hold that level, then I think that could be the start of a major move going up towards 118 and 128. Remember, we're talking yearly outlook here, not just like the next few months. But at the moment, that's holding. So we have to see, is there a pullback off that 38.2%? Now, at the moment, I think that if you see any pullback slower, you have that trend line going across, you have the 23.6% retracement, the initial retracement, which has been broken, and you have that 20 period moving average. And they all cluster together. And so they're all in the sort of 90, 95 area. And while any pullbacks are held by that, I still think the risk is that top side breaks longer term, and we got towards the 118, 128 area. Where do I know I'm wrong? Below 90, something has changed. A quarterly close below 90, and we'd have to sort of rethink, you know, why has it broken? Something has changed in the world. So hopefully that clarifies that. So 90, 95 support, 106, 108 resistance, above 106, 108, dollar strength, another surge of it. So if we go to the next chart now, we're going to have euro dollar. And this is again the yearly chart. Let's look at the big picture. Again, we're not going to talk about central banks, inflation, all that. We're just going to look how simple it is with these lines. We don't have to worry about all that. So what can we see? We've got the Fibonacci retracements, and you can see on those Fibonacci retracements, we've gone from the 160.40 area right down. We went from 0.82 up to the 160.40 area, and we're doing the retracements of that move. Now, what can we see? There's also a trend line coming up. So as well as coming down towards the 61.8, 76.4% and finding some support, there's that black dash trend line going up. Now, that broke the other year. So you had at least 6 or 7 touches to that trend line. It broke the other year. The market's been back up last year, failed at that area, failed at the trend line, come off. So it's nice and simple. We know where the resistance is. The resistance is the 61.8%, which is about 112.12, and the trend line, 114. So if you want euro dollar higher, you need to see price break above that 112.14 bigger picture. And then you're probably going to move up towards the 120, 121 area. But you need to break that 112, 114. However, while you are below that 112, 114, the risk is it comes back down like it is so far this year. It's coming down to test where is support. Now, this market needs to find support before 103.75. And the reason for that is on the next slide. If we can look at the next slide. So this is the yearly candle. And this time I put, it used to be in a long-term channel. It broke that channel. It spent many years bouncing around the base of that channel. And then it broke it a couple of years back, and it's just been going down really since then. So we've got on here the Fibonacci extensions. And on there, we've got 103.79 as the 38.2% extension. So we know where the support is. It's that 103.70 area. So if you start to get sustained price action, let's say a quarterly close below that 103.70, then it would open up the risk there. Actually, the dollar's going to strengthen quite a bit more and head down towards the 97 and 90.90 area, which is the 61.8%. So you haven't got any clear confirmation here. So you can see on this yearly chart, last year was an inside session. So an inside session sometimes is a prelude to actually, we're going to have a little test back against the trend. So it might go back a bit higher. And that's why I'm saying be careful of that 112, 114, because last year couldn't make a new low in this run. But it could be that the previous year was just such a strong move down that it couldn't match that again. So let's just keep it on simple levels, long-term, big dollar picture, and euro dollar 103.70 support. Below that opens the risk of 97 and 90. At the moment, the resistance 112, 114. Above that opens the risk of 122. My bias is that if you do get rallies, they get sold into, and multi-year, we see this lower. So we'll go to the next slide now, which is the sterling index. So on the sterling index, this is the yearly chart. I had this on last month, so there's not actually too much difference here. But the point to notice is that the 20 period moving average comes in around 67.07. So it comes in the 67 area. And the 38.2% retracement of the whole move down for sterling comes in at 69. So I'd say that 67, 69 is going to be a tough area for sterling. However, if it gets above that and you start to see that above 70, into the 70s, then something's changed for sterling, and you're going to start to see even more strength come in to sterling. Quite a strong move, I'd imagine. But at the moment, you're below it, so it's the resistance, 67, 69 area as resistance. Where's support? Support's probably down in the sort of 63, 62, 63 area. If you start to get below that on the yearly chart, then you'd worry about, has this long sideways move? Are we starting to break to the downside? But at the moment, look at that chart. So for the last 1, 2, 3, 4, 5, 6, 7 years, it's just gone sideways. So it needs something to push it out of that range. And that's going to be an event, I feel. Like I said, it's going to be an event that moves it out of there. But let's keep it simple. 67, 69 resistance, 62, 63 support. Outside that, start to get ready for a strong move in sterling. And on the next chart is the quarterly chart. And here we can just look on the quarterly chart, the shorter term move, just down from 2015. We can see the 38.2 was the 64.90 area. Now that capped sterling from 2016 all the way through, and it finally broke in 2023. And what happened there? It's turned to support. Resistance switches to support. So that turned into the support, and we can see that held it quite nicely. So that would be a clue. If you got a quarterly close below 64.90, it'd just be on a bit of a alert. Why is sterling not managing to keep the gains that it's made on this break higher? And then I think that the panic sort of, I don't know if panic's the right word, that the area to really start to take concern on sterling is if it breaks below that 20 period moving average. So if it gets back below 63.70 on a quarterly close, I'd start to have my concerns about sterling. So going to the next chart. Now, I know sometimes I do sterling euro and not euro sterling. Neil tells me that his whole fan base loves it on a sterling euro basis. But on the yearly chart, it just doesn't work. I've got the sterling euro chart behind this, and it will be sent out in the pack with the levels, but the retracements don't work. And that's because it's not the traded commodity. The traded commodity is euro sterling. So if we look at this chart, it's a lovely chart because you can see that if we look at the rally from 2000 and sort of going from 2000 up to 2008 and put those retracements on, look at that 38.2% retracement. Now, regardless of who was prime minister, general elections, interest rates, inflation, unemployment, all that stuff. This is what I'm saying. You don't really need, I don't think, in a way, to know all that stuff. You just need to know where the buyer's interested in buying it, where the seller's interested in selling it, where does the market change its view. So the 38.2% is down at 82.16. And ever since 2016, whenever it's touched that line, if you look closely at this chart, it's rallied. So you haven't had a yearly close below that. So 2 years ago, positive for euro sterling. Last year, negative for euro sterling. It's just sideways. Look at that. So, but just above the 38.2, which comes in the 82 area, above that at 83, you have that 20 period moving average. So if you want sterling to be a long-term strengthening, you need to see it below 82, on a sustained basis. Now, I know these are yearly and you probably don't want to wait a year, but I'm saying you need to see it get down below 82, hold there, and then I think it starts to go down. Where is the risk on the upside? I think that if we were looking at the upside, probably about the 87.5, 88 area. If it starts to get above there, then sterling's starting to lose the shine it's sort of had recently. I just watch those two areas and just see how does that go from here, along with the sterling index. So the sterling euro levels will be on the chart, and I'll put some commentary on sterling euro levels. But if we go to the next slide, you'll see we're nowhere near the 38.2%. That's up at sort of the 130 area, with 120 at the moment, the 23.6. So maybe above 120, 122, some resistance. If it gets above there, maybe up towards 130. But I don't really trust the sterling euro charts too much when they don't align with euro sterling. So we go to the next slide. This is sterling dollar. There's, I'm not going to spend long on this because there's not too much. It's a long way from anywhere really on this chart. But what you can see is if we're talking big picture, you're still way below that 20 period moving average. You're still quite some way from the lower band on the Bollinger Bands. It has just gone sideways since sort of the 2016 time. And the one thing we can see is that the 137 area is where has capped it, because that's the 23.6. So it's done the initial retracement, and that's really about it. But so I'd say 137, 142 is major resistance. And to get positive on it, you need to see it above sort of the 149 area. But that's multi-year big picture. Remember, we're looking at long-term views here. So we go to the next chart. Let's just see, where could the downside possibilities be? Now on this chart, you can see there's a trend line, very nice trend line going from 1984. Look at all the times it hit 2015, 16. Then it's held the rallies, it's held the dips ever since. So that comes in at 117.5, 113.5. So that's where on a long-term basis, if you start to see sterling dollar down below 113.5, 117, something's starting to change, and the risk comes at 95 long-term extension target I've had sort of since some time ago. This is actually a very useful chart. This is one of the charts that helped me sort of look for that 130 area when we're back sort of 2012, 13, because we had that candle formation just to the left of the 38.2% off the 71.92 engulfing body candle. It's had sort of like a hanging man before that, and the market just crashed off. So keep an eye on these. Again, what's nice here is the 38.2% is 142.67. So it ties in with that 137, 142 from the other chart. That should be resistance if you do see rallies on the long multi-year sort of look. Now, the final slide here on sterling dollar is the yearly chart, just showing the 8-year cycle. So every 8 years, sterling dollar has historically had a bad year and ended lower than it started. So that I just keep in the back of my mind. That's something I think you do need to sort of keep a little bit of concern about. It's no guarantee as cycles can break, but personally, I still fear the year 8 for sterling dollar. Now, the last thing I'm going to do is quickly look at a couple of slides on equities. Is there a bad moon rising is my sort of worry. Because this is the Dow Jones Industrial Average chart, prices going up. For the last 14 years, you've seen higher highs on the Dow Jones Industrial. So hooray, everyone's happy, equities up. However, if we go to the next slide, which is the Dow Jones Transportation, that's not been the case. For the last couple of years, if you include this year, 3 years so far, the Dow Jones hasn't been making new highs. And this is called divergence between the markets. And that starts to worry me, because for the last 10 years, it's been correlating. They've both been showing that price is going higher. But that sort of makes me a bit worried on equities. And on the Gann calendar, if you look at the Gann calendar, 2024 is supposed to be a bad year for equities. And also there's a 18-year cycle on the stock markets, and that comes in on 2025, 2026. So I'm not saying tomorrow, but I'm saying over the next 3 years, I'd just be concerned on equity markets that at some stage there is a major sort of pullback as the market takes back some of these huge gains that it's had over the last sort of 10, 15 years. So that's the thing. Now, the reason I thought I'd just say this is it's not financial advice. It's just my thoughts looking at charts and cycles. And it's just for educational on these sort of webinars. So anyone acting on them does it entirely at their own risk, as these charts are simply my personal thoughts and not designed for trading. But I'm just sort of saying, what happens if the stock markets do have this major fall? Usually there's a flight into the dollar, and that could be a trigger to strengthen the dollar if it does play out long term. And I couldn't do the equity markets and not look at the next slide, which is the Footsie. So the Footsie, we can see those two black dashed lines are sort of containing the price action. Now, the top one has been holding it for some time. And yes, you know, if you get above 8,300 in the Footsie, you might see a spike higher. But I still think, you know, those 3 years, I'm sort of worried about this year, and then 25, 26 in that blue lines. I just think just be careful on equities. It hasn't given the absolute signal, price is king, so always wait for the actual price action to give the trigger that it's happening. But I'm just saying it's a warning, just to be on your guard. But anyway, that's me done, Neil. Thanks very much. There is a disclaimer. Yeah, don't forget the disclaimer.
Thanks very much for listening to the webinar. We hope you found it informative. The next in the series will be available shortly.